Welcome to another video, guys. This is King Kelks, and in this video we're going to be continuing our technical analysis series, and we're going to be discussing market structure. Right, so in the previous videos we've talked about candlesticks, right? We've talked about how price is delivered, expansion, retracement, reversals and consolidation, and now in this video we're going to be talking about market structure. So essentially, what are we trying to outline in this video, right? So we're trying to outline first of all, how to outline a bullish market structure, how to outline a bearish market structure, and how to outline a shift market structure. So in the previous video, we talked about how bullish means going up, right? So that's higher prices, while bearish means lower prices, right? So how do you outline when market structure is indicating that we're going towards higher prices? That's what we mean by bullish market structure. How do you outline when price is indicating lower prices? That's what we mean by bearish market structure. And then how to outline a shift in market structure. So assuming we were bullish, right? How will you be able to outline when we have shifted from bullish market structure to bearish, right? So basically, how do you outline when price is indicating that it's no longer offering higher prices, but it's going towards lower prices? That's what we mean. So let's hop onto the chart and I'll show you all that. Alright, so we're now on the charts and I'm going to do a little bit of illustration here. So I said I'm going to be showing you a bullish market structure and a bearish market structure. Alright, so in a bullish market structure, essentially what we're looking for is something like this. Alright, so what we're doing here is that in a bullish market structure, we keep forming higher highs and higher lows. Okay, let me explain this further. So this over here is a higher high. I'm going to use HH to explain it, to represent it. This is a higher high, right? And this over here is a higher low, right? So when price keeps forming higher high and higher low, that's a bullish market structure. What do you mean by higher low? If you notice over here, this was the previous low, right? We now formed a high, but then this low did not break this low. It closed. It is higher than this low. That's what we mean by higher low, right? And then this new high is higher than the previous high. So it's the new higher high. Why this low? Assuming this low was below this, we can't call this higher low, right? We'll call it lower low. But because it is higher than the previous low, it's called higher low, right? While this high is called a higher high because it's higher than this high. So this is our higher high and higher low again. So when price repetitively keeps forming higher highs and higher low, right, that is a bullish market structure basically. Now what about bearish? In the bearish market structure, price keeps forming what? You should guess it by now. Lower highs and lower lows. So this is what it looks like. Right? So here we were forming higher highs and higher lows, while here we are forming this a lower low and this is a lower high, right? So in this case, remember, we keep forming higher lows because the lows, right, don't break previous lows, while in this case the lows keep breaking each other. So we keep forming lower lows, we keep forming lower lows, we keep forming lower lows, right? Why the highs, in this case, in a bullish market structure, the highs are higher than the previous highs, while in this case the high fails to close above the previous high. That's why we have a lower high, right? So bullish market structure is characterized by higher highs and higher lows. Bearish market structure is characterized by lower highs and lower lows, right? Now what's happening at this point whenever we close or whenever we go higher than the previous high, what that is called is a break in market structure. So this was our previous higher high, right? And then market price came and went above it. So whenever we close above previous high, what we have there essentially is a break in market structure. So let me outline that with BMS. So we have a break in market structure here, right? Now we can't say there's a break in market structure here because this low did not close below this high low. But what do we now have here? This previous high was broken to the upside. So that's a break in market structure, right? When we cross this higher high again, another break in market structure. So you can say a bullish market structure is characterized by breaking market structures to the upside, right? While for a bearish market structure, what do we have? We have breaking market structure to the downside. So we repetitively keep having breaking market structures to the downside, right? Breaking market structure to the downside, so thereby forming lower lows, lower highs, while here higher highs and higher lows. Now it's important to note that the higher time frame is the king, right? Because when you're on your trading view, you see that we have a couple of time frames. We have the monthly, right? We have the weekly, we have the daily, we have the 4 hour, we have the 1 hour, we have the I'm even skipping some. There's 2 hour, there's all this. I'm just calling some the most used ones, right? 1 hour, we have 15, right? We have 5, we have 1 minute. So it's important that you know that the higher time frame is king, in the sense that the overall market structure, right, will of course be determined by the monthly market structure, then the weekly, then the daily, then 4 hour. So now, for example, assuming you have this kind of formation of higher highs and higher lows on the 1 minute, you don't really expect to say, okay, if it's on GBP/USD, you don't really expect to say, okay, in GBP/USD we are bullish or we are bearish just because this thing is being formed on the 1 minute, right? Because it depends on the time frame you're talking about. If you're trying to look at it in the long term, right, you cannot say we are bullish because this setup is forming on the 1 minute or the 5 minutes or the 15 minutes. So the higher time frame is king. And what's the higher time frame in this scenario, right? Typically monthly, weekly, and daily time frame is the higher time frame. Is what we will use to characterize whether we are bullish or bearish in the long term, right? So now let me say this. We have different types of traders, right? We have long-term traders, right? Position traders. We have swing traders. We have day traders, right? So let me just use this. Let's say long-term traders. Long-term traders. We have swing traders. We have day traders. So I am a day trader, and the strategy I'm going to be using in this series is day trading. Strategy. So now, if you are a long-term trader, you're trying to be looking at the monthly, the weekly, because you can be in a position for weeks to months, right? So let me put this here. Long-term trader, you can be in a position for weeks to months, right? That's also position traders / position traders. So that's weeks to months. If you're a swing trader, you can be in a position, right, for days, right? So a number of days. If you're a day trader, you'll be in a position within 24 hours, right? So you can open a position in the morning. Perhaps you're out still in the morning, or you can be out in the afternoon or evening, but essentially you're trading within the daily, within what's happening in 24 hours, right? So intraday. So these days, it can be 2 days, it can be 3 days, it can be 4 days, it can be 5 days, right? That is swing trading. When you're a long-term trader or position trader, you're trading weeks to months, right? So you know, of course you'd want to know what's happening in the higher time frame to kind of do your analysis around that, right? But it's important that you keep in mind that the type of trader you are is going to determine the time frame you are going to be doing your entries, your execution, and everything. Me, as a day trader who trades within intraday price action, I can't come and be doing analysis on monthly and want to enter on the monthly time frame, right? I can't come to the weekly and just trying to do analysis. So essentially, as a day trader, what I do is that I focus on the daily time frame, and I'm going to be showing my strategy later. I focus on the daily time frame, right? I focus on the daily time frame, and so I outline my trend, because when we're in a bullish market structure, we can see we're in an uptrend. When we're in a bearish market structure, we can see we're in a downtrend. So let me just put that here. That's uptrend. Well, this is downtrend. Alright. So what I do is that I determine my direction, or the direction of the market on the daily, right? I come to my 1 hour, right, and then I make my entries on 15. So I determine my direction with daily, come to 1 hour to further determine my direction, and then I make my entries on the 15 minutes time frame, right? So I don't spend much time on the monthly or weekly. I might go to the monthly and weekly to glimpse at what's happening to see overall trend, but I typically spend more time on the daily. If I come to my charts in the morning, I don't go beyond the daily. Maybe at the beginning of the week I might check what's happening on the weekly, but if I come in the morning, I check daily, then move to my 1 hour, and then I wait to see my setup form on the 1 hour and go to 15 minutes for my entry. All of that will be discussed in subsequent videos, but for now let's keep going. So for now, let's go to the charts and try to outline a bullish market structure. So we say the bullish market structure is characterized by what? Higher highs and higher lows. So let's see this over here. At this point, let's begin from this point, right? So let's say this is our this was the lowest low at this point, right? So let's start from here. Now let's call this our higher high, HH, right? Then let's call this our higher low. Why? Because it did not close below this low, right? So this is a higher low, and this for bullish. So let me use green just so that you don't get confused. Okay, so higher high and higher low. So now, what do we now see here? Another higher high is formed. So let's bring this here. That's our new higher high. And then, what do we have again? A higher low. Okay, so now, here's where I have to explain something just so that you don't get confused. In order for us to validate this, right, as a higher low, a new higher high must form. And how do we validate a new higher high? That is where the concept of break of market structure comes in. Now, to identify a break of market structure, right, the candle body must close above wick. So let me write this. For structure, we use wicks. For break in market structure, we use body of candle. Break in market structure, we use body of candles. Wicks of candles in the case of structure. So at this point, our higher high will be this point here, the top of this wick, right? That's our new higher high, right? So this higher high is also this point, the top of this wick, right? But at what point can we say we've had a valid break in market structure? Is when the body of the candle closes above the wick, right? So let's say this is a wick over here, right? And later in the future, so these are higher high, these are higher high, right, formed by the wick, and then later in the future price comes and trade, but instead of the body of the candle crossing above this higher high, we have a wick just crossing. Then we cannot call this a break in market structure actually, because it's just a wick that passed through. But the point at which, so this is not a higher high, let me just put, this is not a higher high, not at all. So we cannot just say we are bullish at this point because the wick passed. No. So the point at which we can say we have actually broken this higher high and formed a new higher high is when the body of the candle comes and closes above this higher high. So where is that again? So for breaking market structure, we use the body of the candles. For structure, we use wicks of the candles. So these are higher high, the top of this wick. Now let's come real close. You see when this wick closed above this higher high, now you will have said, okay, now we are bullish. No, we are not, because at this point, see where the body is. The body never closed, and keep in mind I say closed, right? The body never closed above this higher high. So the point at which you can now say we are forming a new higher is when this, the point at which you can say we have a break in market structure is when this body came and closed here. Then now we can say yes. So it's at this point right here, this point, that we had a break in market structure, right? So that's a valid break in market structure whenever the body of the candle closes above, right? So that's for bullish scenarios. Look at it again here. Over here, we can clearly see that this candle, this wick came and bypassed or passed through this higher high, but we cannot say we've had a break in market structure at this point. So it's not a break in market structure. It's not. But at what point can we say we have a valid break in market structure? Is when at this point right here, this point right here, can't make it any smaller, right? It's at that point right there. So at this point now, we can now see we have a valid break in market structure, right? That's over here, so that's how we characterize our higher highs, right, and higher low. So because this high is higher than this one, right, that's why we call it higher high. Because this low is higher than this particular one, call it higher low. Now this is our new higher high, right? So in order for us to confirm that this is a higher low, we need to actually go and form a new higher high. So look at this scenario. Assuming we've formed a higher high, higher low, higher high, right? And then something like this now happens. We form a higher low, right? And then something like this now happens. You can now say, okay, we've broken market structure, because the body closes below this. You can say we've formed new market structure, we're now bearish. We're actually not. Why is that? Because as long as this was our higher high, right? This was the new higher high. This was our higher low. Stay with me, guys. This is our new, is it? So a higher low is not yet confirmed until it breaks the higher high. So everything it does before it breaks this higher high cannot be characterized as higher low. So actually, when it comes and does this and breaks this one, you cannot say that now we are now bearish. We are not. Because in order for this to be characterized as a higher low, we must form a new higher high. So something like this could actually happen. After it does something like this, you notice that it has still not broken this higher low. Assuming it actually came and broke this low here, we can call it a break in market structure. Why? Because there was a valid higher high after the formation of this higher low. But in this case, there was not a valid formation of higher high before this was broken. So we cannot call this a higher low thus we cannot call it a change in trend, right? So something like this could actually happen. When we break this one here, we could now see continuation in upside movement, and we are still bullish. Why? Because the valid higher low was never broken. This is not a valid higher high. It never broke this high. It's at this point here, at this point where the valid higher high was broken, that we can now say, okay, yeah, this is actually our higher low. So the last low before there's a shift or break in market structure is the valid one. So this is our higher low, and this is our high high. These are new higher low, and this is our new higher high. So market structure can be a very powerful thing if you understand it. You need to understand market structure. I think it's one of the break it or make it kind of things in this market. Once you understand market structure, even the strategy I'm going to be teaching you towards the end of this course, it's all about understanding market structure. If you understand market structure, then you're halfway there essentially. So what have we understood? Let's go back to this point here. All right. So we've understood that we have two types of market structure. We have a bullish market structure and we have a bearish market structure. When we're having a bullish market structure, we are said to be in an uptrend. When we're having a bearish market structure, we are said to be in a downtrend, right? And a bullish market structure is characterized by the market forming higher highs and higher lows, right? So if you remember from the previous video, we can say that this is an expansion and then a retracement. Expansion and retracement. So we keep having expansion and retracements that keep going to the upside, right? So expansion, retracement, then we shift market structure higher, then we retrace again, shift market structure higher, retrace, shift market structure higher, right? While in a bearish market structure, we say it is characterized by lower highs and lower lows, lower highs and lower lows. So we keep breaking or shifting market structure to the downside. So we keep breaking lower lows, right? And we also say that in order for us to have a valid, let me write this down so that this will actually be ingrained in your memory. So we only have a valid break in market structure when the body of candle closes above or below the wick. We only have a valid break in market structure, right? Or market structure shift. Let me just put this here because I'm going to be using MSS down the line, right? So we only have a valid break in market structure or market structure shift when the body of candle closes above or below the wick. So in a bullish scenario, if this is our high over here, we only have a valid break in market structure above this, right? So this is only valid when the body closes above it, right? So this is a closed candle. It has to fully close. Let it not be that you're trading, right? Let's say on a 30-minute chart and then it's still like on 20 minutes and then you see that this body is here and then you're like, yeah, we have shifted market structure. No, the candle has to close and then a new candle is starting. When a new candle starts and then this one has fully closed above this, then yes, you have a break in market structure. I cannot stress this enough. There's a reason I keep coming back to this. So just know there's a reason I keep coming back to this. So when it's not like this and it's the other way around, then that's fake. So it's fake when it's a fake out when this does not actually close above it, but instead the wick is what bypasses it. It's fake, right? That's for bullish scenario. While for a bearish scenario, we have our lower low, right? Let me change this to red. Maybe you guys will take a screenshot. You guys have to go to your charts and check these things out they will make sense. You need to put in the time and effort on the chart. When you put in time and effort onto the chart, you actually study all these things. It will get ingrained in your memory. But you can't expect that from just the videos you're watching, right? You won't go to the charts and try to outline them. You just go and start trading off of these classes. It doesn't work that way. Trading won't work that way. You're going to have to go and spend time on the charts. After each video, go and try to outline every single thing we talked about in the video, right? Go over it again. Go over the video. If there's something you don't understand, perhaps just go to I'm going to be in a particular video I'm going to be talking about places where you can go and check things, and I'll try and leave some other materials that you can use for further studies, so that you can actually put in the time and effort into understanding all of these things. So a valid break in market structure to the downside is when this candle closes below it. So at this point we can say we have a BMS, right? Break in market structure, right? Why it is fake when what? The body does not actually close below it, but the wick, right? So this is not a break in market structure, this is a fake out, right? I'm going to be explaining more of these concepts later. So now this is everything we've talked about so far in the video. So structure is determined by wicks of candles. Breaking market structure is determined by body of candles. Bullish market structure, bearish market structure, and we did a couple of illustrations down here. So finally, let's go to the charts and outline these things we talked about. All right. So I'm just going to be using this tool now. I don't want to be writing high, low. I'm sure you can be able to see it now. So at this point, what do we have? High. Then we have a higher low. We now have a higher at this point. Then a higher low, right? We now have a higher here. Why? Because this is at this point that the candle closed above it. So this is the high. Then we have higher low. Then higher high, right? Then what? What do we have? This is actually, can we call this higher low? Okay, so let me pause this and you see why I talked about that thing earlier. So can you see something here? You will have called this a higher low. This point right here, you will have called it a higher low. Why? Because you'll be like, okay, no, we have formed a low and now we are going to the upside. But remember, you cannot call this a higher low until we have broken market structure above the confirmed higher high. Why is it confirmed higher high? Because we have a higher low and then we now broke market structure here. So until we break this higher high, this is not a confirmed higher low. And what do we now see? Price traded below what you will have thought to be a higher low, but it did not come and trade below this low. And this is our what? This is actually our confirmed higher low. These are confirmed higher low. Why is it a confirmed or a validated higher low? Because when it was formed, price broke market structure above the wick, right, to the upside. So this is the confirmed higher low that formed this confirmed higher high, right? I'm making so much emphasis. I think this video has to be the longest since we started on the charts. I'm making so much emphasis on market structure because it's very important. But this is not a higher low. It's not a higher low. It's not a higher low because price never did come and broke like above this higher high. But at the point which it comes and break above this higher high, we can now call this what? Higher low. And then this over here, higher high, right? So now we can keep going. So higher high, then what do we have? Higher low, higher high, higher low, higher high, higher low. Now here's what, see what happens. Higher high, but instead of us forming a higher low, what now happens? Breaking market structure to the downside. Why is it a valid making market structure to the downside? Because here's our wick right here, and the body of the candle closes below it. So we can call this breaking market structure or market structure shift, right? So now I've shifted market structure to the downside. So now what does that mean? Essentially, we went from an uptrend to what we can now start calling a downtrend, because the valid higher low, right, that should not have been violated, has been shifted. Market structure has been shifted to the downside by breaking right below it. So let me delete this, which means now what are you expecting? You're expecting us to go on to start forming what? Lower lows and lower highs.